What's up, you guys, and welcome. It's Cory here. Today, I want to talk about investing with index funds. Everything you need to know to get started to invest. First, I want to define index funds. Second, I bet nobody has ever told you that the market always goes up. We're going to talk about that in a minute. And then I want to talk about compound interest, a wonder of the world. Today, we're going to dive in and talk more about investing with index funds. Please consider subscribing or liking if you're getting value from these videos. So if you're new to investing, let's define index funds. Index funds are basically a mutual fund. Now, mutual funds and index funds are very different, and there's some key distinctions that we're going to need to make between index funds and mutual funds. But for the sake of this video, index funds are a basket of stocks, bonds, or other securities that you own. A mutual fund, on the other hand, is designed to try to beat the market. We're going to talk a little bit more about this later on in the video. But the differences between the two are an index fund is passively trying to mimic or match the market, say the S&P 500, for example. A mutual fund, on the other hand, is trying to beat the market, which in previous videos we've already established that no one can ever beat the market on a consistent basis. We'll talk more about this in a minute. David Swensen says an incredible 96% of actively managed mutual funds fail to beat the market over any sustained period of time. So to be clear, when I'm talking about the market, I'm referring to a stock index. And a stock index is simply the S&P 500, the Russell 3000, or other indexes that track a particular stock or bond or security index. He also goes on to say in the book, Unconventional Success, that when you look on an after-fee, after-tax basis over a reasonably long period of time, you almost never wind up beating the index fund. Number two, the stock market always goes up. Now let's be clear, when I'm talking about the market always going up, I'm talking about a long-term investment strategy. I'm not talking about a short-term, day-to-day, or even week-to-week investment strategy. The market always goes up refers to the 10, 20, 30, or 40-year investment strategy that you should be implementing in your investment plan. The stock market is one of the greatest wealth-building tools that mankind has ever seen. If you look back to 1974, when Jack Bogle, the founder of Vanguard and the creator of the first index fund, you'll see that over time, the stock market always goes up. Now, I'm not talking about a lack of volatility. Volatility is something that is always present in any given market, climate, or experience. The market has ups and downs. But if you can toughen up and hold on to your investment over the long term, you will always see an increase. Now, a little bit of history on the index fund. Jack Bogle, the founder of Vanguard, the creator of the index fund, before 1974, the average person had to invest in the stock market via a mutual fund. The creation of the index fund made it accessible for the everyday person to access and invest in the overall market. The short-term investment strategy is almost like competing in the Olympics. You're competing against Paul Tudor Jones, David Swensen, Warren Buffett, and I don't know about you, but I can't compete against those guys. So my long-term investment strategy refers to index fund investing over the long term. By definition, short-term investing is generally considered gambling. You never know whether the market's going to go up or down. And if you do, you'll wind up on CNN or NBC and people will call you a genius. Mutual funds also to some extent are a speculative investment because you're putting your hope in a mutual fund manager to potentially beat the market, which we've already established is exceedingly difficult to do so over the long term. Number three, I want to talk about the power of compound interest in your finances. Let's look at history for a minute. I don't know about you, but I wasn't the greatest history student in the world. However, when it comes to investing in the stock market, history can be our greatest ally. Let's take a look.
So compound interest is actually interest earning money on top of interest. So if you invested $100 with a 10% return, you made $10. That $10 is making money on top of the $100 you invested.
Hypothetically, if you took $12,000 in 1975 and invested it in the S&P 500 with dividends reinvested with a return rate of 11.9%, which is actually what the S&P 500 returned over that period of time, in January 2015, 40 years later, if you went and looked at your money, you would have well over $1 million. That's incredible. Don't have $12,000? No problem. If you started in 1975 and invested $130 a month, that's $1,560 per year over the same 40-year period with an 11.9% return rate. You would have $980,000. Now, if you wanted to up your investments $150 a month, that's $20 extra a month, $1,800 per year. Over 40 years, you would have $1,136,656. That's amazing. The power of compound interest at work if you invest your money for the long term and leave it alone.
So I've chosen to invest in Vanguard's Total Stock Market Index Fund, and this is VTSAX, and this is what's called the Admiral Shares version of the Total Stock Market Index Fund. People underestimate the drag of cost. We talked about that earlier on in the video, but as you can see here, the expense ratio on VTSAX is 0.04%. That's one of the lowest costs that you can find. VTSAX is also what's called self-cleansing. That means that the top companies will continue to grow as they do, but companies that go out of business, they're taken off the index. And other companies that grow to take their place will come back onto the index. So that's basically what self-cleansing means, is the companies that go out of business, they fall off the index, and the companies that continue to thrive and grow remain on the index. So here's a list of the top 10 largest holdings for VTSAX. Number 1 is Apple. Number 2, Microsoft. 3, Amazon, Alphabet, Facebook, Tesla, Berkshire Hathaway, JP Morgan Chase, Johnson & Johnson, and Visa. So this is, again, the Total Stock Market Index Fund Admiral Shares. There's also a minimum investment of $3,000. However, if you don't have $3,000 yet to invest into VTSAX, there's also an exchange-traded fund version of the Total Stock Market Index Fund, and it's VTI is the ticker symbol. So an exchange-traded fund is bought and sold like a stock on the stock exchange, and it's basically the exact same fund as VTSAX. Expense ratio 0.03. There's no minimum investment, and it holds basically the same companies. Now, just to compare and contrast for a minute, I want to show you Vanguard's 500 index funds. And this is, again, the Admiral Shares, VFIAX, and this tracks the S&P 500. Also, there's an exchange-traded fund version of it, an ETF, ticker symbol VOO. Expense ratio is 0.03. So these are the top 500 companies in the United States that this fund tracks. So again, pretty similar holdings. It has 507 stocks in its holdings VOO. A little bit different with VTSAX, as they hold over 3,000 companies. So this is the entire US stock market that you're tracking. Very similar returns, very similar performance, two very, very great index funds for you to consider.
So don't take my word for it. It's simple math. Do your research. Know all of your facts before you invest in anything. That's a great rule of thumb when investing for financial independence. Thanks for joining me again, guys. I had so much fun putting this video together. I hope this added some value to your life and you took away some crucial information about investing. Remember, if your money could talk, it would say, I'm a tool and a test. I'm a means and not an end. I can add meaning to life, but I'm not the meaning of life. Have a great day, guys.